Hey guys, today I've invited Ron Fossum with Tax Plan Well to answer some quick questions about working with a tax planner for your business. How are you doing today, Ron?
I am really good, thank you.
So my clients are constantly asking me how can they utilize their deductions better by the end of the year to reduce their tax liability.
It usually starts with trying to not do what everyone else does. Most business owners wait to the end of the year, dump everything in their CPA's lap or their tax preparation person, whoever's doing it. But everything's already said and done for the whole year, so it's really tough to go backwards and implement things. So if we look at this, let me show you a breakdown of the whole industry real quick. This is kind of how the tax and accounting gets lumped together, but really, as you know, these are two totally separate worlds.
Yes.
So from the bookkeeper, the accountant, and the CPA, it can be one of those people or multiple people trying to get you to your tax prep. And the way they're trained and the way their job is really geared is the business owner goes out and makes decisions. And then in hindsight, after the fact, these people are trying to react to what has already been done. It's very methodical, step-by-step type processes, very tactical type processes, versus a tax planner or a CFO. These two are highlighted because that's where I spend most of my time. We're tend to be more proactive and more strategic about it. And so the best thing to do is to start planning your year going forward, just like you would have a business plan and just like you would have a financial plan before you go invest, is have a tax plan so that you can schedule things out and have time to implement them throughout the year. Then you get them with what you do, you get it into the books properly. The tax return is going to be a good natural byproduct of a great set of books that's been implemented with a tax strategy through the whole year.
Awesome. So if they already have a good bookkeeper in line, that's one step, but you're advocating that they can have multiple players on their team that you've listed here.
Yeah, absolutely. And if they've got a long-standing relationship with a bookkeeper, accountant, CPA, they don't have to stop working with that relationship at all. And that's the other reason I like to show this it's a completely separate process to go in and tax plan. I don't want to do books. I don't necessarily enjoy tax prep. We have some team members that can do it if you really need us to do it, but we kind of take the Warren Buffett approach. We would encourage, if you've got a relationship, keep those relationships in place. Let's just implement some things and then document them properly so you qualify for paying the least amount of tax legally, morally, and ethically.
So you're working harder, you're working smarter, not harder. And your money's working better for you that way then. That's something one of our big missions is with Clearview Bookkeeping is making their money work for them.
And as business owners, we work hard enough for our money. Working for the money is one skill. Keeping the money sometimes is an entirely different skill.
Right.
That's where this all spawned from. Was I got tired of working so hard. I wanted to keep more of it.
So some of my clients already do like a year-end tax planning. How does working with someone like you work with something that they're already doing? Would you recommend them continue or adding on or totally revamping?
Yeah, end of the year tax planning is a common expression in the industry, but it's almost like that oxymoron, jumbo shrimp or something. If you're at the end of the year, like it's already over. At best, you're doing a projection for what that last quarter is owed or what you're going to pay for the all of last year. It's more of a calculation with simple math of here's what you're going to have to owe. Tax planning truly means, by definition, a plan is something you put in advance of the activity. And so here we are, we're in May right now. And so if your team is busy looking at 2019, they're a reactive type firm on the top part of this form. And if they're looking at 2020, which is the bulk of what we're doing already, is how do we plan this year, especially amidst all the chaos that's going on with businesses being forced to be closed and COVID and all that stuff. How do we plan for this stuff going forward? And that's really where you're going to find some strategies that really move the needle for you.
I think that the key words there was respond, plan versus react, especially in times like this, that being able to know enough to respond and navigate good or bad markets. Bad, it makes it a little bit shakier, is key to one, good financial health. And I think it really lowers the stress level in your business, so you're making really good decisions.
Yeah, yeah, absolutely. The more we can take the emotion out of the out of the equation, the better.
True. So, how does your team approach tax planning for your clients?
Well, we try to analyze what they're currently doing in their day-to-day activities, and if we can identify maybe they're doing this activity and this activity, and if we just do one more thing, add to that, they can qualify for another deduction, another credit, another exemption, or something like that. And so that's really where it is. We find out what they're already doing, look at their tax returns, but then drill into what their activities are or what they're really close to almost being able to do, identify that, and then show them how to document that properly so that we can get that into the tax plan and the tax strategy.
That sounds good. I mean, it piggybacks what they're doing. You're not going to come in and just wipe out what they're doing, or say, hey, you're doing this wrong. It's more proactive, talking about ways to implement a better way of what they're already doing right now to save them some money.
Exactly.
Would you be able to give us some examples of some tax planning that you've used?
Yeah, for sure. Let me pop that back up real quick. So most of us know as business owners, we should be doing some corporate minutes and resolutions for our business, some amendments when we change how we do business and that kind of thing. We should have an operating agreement, articles of organization, and those types of things. But when I tell people that sometimes they don't even have to claim certain types of income, like that disbelief starts to show up. So this is publication 527, and it's talking about when is this a residential property, when is it a rental, when is it a vacation home, and that kind of stuff. I won't bore you with the whole thing, but if we know it's a law that in order to keep our corporate veil in place, we should be having some meetings, then where we have the meeting is up to us. And so on this one, what type of property qualifies for you being able to rent it out? And it's a dwelling unit is what they call it. And if there's a special rule that is used as a dwelling unit, as a home, you rented it less than 15 days a year, then it could be a house, an apartment, a condominium, a mobile home, even a boat or a vacation home. All of those qualify. So ownership, doesn't matter if it's an apartment, it could be a rental, doesn't matter. So long as you have these three things right down here: a sleeping space, a toilet, and cooking facilities. So you have those three things. This is the type of place that can qualify wherever you live. And here's the tax benefit. If you use your dwelling unit as a home and it's rented less than 15 days during the year, its primary function is not considered to be a rental. It should not be reported on Schedule E. You know that Schedule E is where we show up all our real estate. And you are not required to report the rental income or the rental expenses from this activity. So if it's
Free
a law,
money.
yeah, light bulbs tend to start going on right here. If it's a law that you have to have these meetings, then have them in your home. Your business has this EIN number. You personally have a social security number. And so you have the business meeting. You personally rent to your EIN, to your business. It's deductible as a meeting to the business to rent out your entire house, not to be confused with the home office, which is only a small portion of the house. You can rent out your entire house to your business, deductible to the business, tax-free income to you. And you can do that 14 days a year.
I know some clients will probably be a little angry with this thought process, because I know they've probably paid some taxes on some money they could have had reduced there for sure.
Yeah. A couple others that pop up is, you've got the home office. A lot of people don't take the home office because they think it might be a red flag for an audit. That's really old school, like 1970s. That might have been the truth, but not today, especially during times of COVID. Like Everyone was working from home. So it's extremely common. Having a home office typically increases your business mileage on your vehicle. And sometimes the business mileage on your vehicle deduction is more than the entire home office. But because you have the home office and every time you leave the house now with a profitable intent, it could be a business mile. So you end up picking up more deductions there. Employing your children and how to do that properly inside the business can be $12,000 per child now, up to $18,000 if you include another strategy and kind of partner those together. How to buy a business, how to sell assets. I've got a client who's selling some Apple shares that he bought at $1.57, and it's creating a $2 million capital gain for him. And we showed him a set of 3 strategies to do side by side that is going to wipe out a $2 million capital gain tax.
Jeez.
Under this CARES Act that was passed because of COVID, there's a 5-year look back for net operating losses. So if someone went into this year with a loss, but they've paid taxes in previous years on profits, you can take this loss and go back 2 years, 3 years, or 5 years and recapture some of the taxes you've paid previously. And so there's all kinds of different things we can do.
So it's not too late looking backwards. There's still possibly some things that can be done.
Oh, absolutely. Absolutely. 19 is still on the table, and so is 20. 2000.
Good.
Yeah.
So I know we talked about having everybody on the same team, but I know people get a little nervous as we start to add team members. They think, well, does that mean I have to change my current CPA or bookkeeper? And again, you just say, no, leave everything in place. It's better to leave that as is.
There's only 2 situations I would really encourage someone to ever leave a professional. One is if egos are just getting in the way and they're not operating in a way that serves the best interests of the client. And the second one would be is if they've just simply, their business has outgrown that professional. Bill Gates does not have the same bookkeeper he did when he was working out of his garage, right?
Right.
So if your business has evolved over time and you've outgrown that professional, then maybe that's the case, but certainly not just because we're adding a tax plan. That's not a real reason to ever leave somebody, no.
Awesome. Okay. So how do you charge for your services? How do we help our clients understand? They might say, this sounds really great, but I'm not sure what it will take to get into the system.
Yeah, so we just look at the complexity of someone's situation. Our most expensive tax plan we've ever been involved with was a $25,000 fee. We saved the client over $250,000, and it was more complex because it was a 100-member LLC. It was just silly. We didn't charge enough on that one. It's surprising. That one was so complex just because of the sheer number of the people involved. Had nothing to do with the actual tax return. That $2 million client that I paid nowhere near that amount. So it has nothing to do with how much we can save you. It just deals on how complex your situation is, how many entities are there, those kinds of things. If you've got 3, 4, 5 entities, that's more complex than a brand new startup company who's just coming out of the gate. So it's all around the complexity, and we fully disclose that right up front. Once we understand your situation, we give you a quote. We guarantee a tax savings number as a minimum savings. Based on what we see, you'll save at least this much money. Here's our fee. If we can't save you that much money, we just return the fee. So far, that's never happened. So we'll keep, hopefully, we're being conservative on that number. And so it's just a real value proposition. Like as a business owner, we're used to saying, I'm going to spend X and I'm going to have a Y kind of rate of return. And so we do all of that up front. Usually takes us a week to 2 weeks to get a tax return done, because we have everyone on the team has got to look at it and kind of give us a different perspective of what strategies we should employ. But by the time it does the round robin on the whole team, it takes us about 2 weeks to get one back.
I love the ROI, the return on investment. They're going to see upfront what that number looks like. And I know I've dealt with people you and I've worked with together. That number can be shocking. They're like, wow, this is great. And it actually follows through. So not only are they going to save money currently and moving forward, but like we said, you can go back and that number for you seems so simple. For them, they never thought it was possible. So it's an immediate return on their investment with you.
Yeah. The numbers we use are year one, and then they have the strategies. Like they're going to get that over and over and over again.
Right.
The number gets to be ridiculously large by the time they implement those strategies multiple years, for sure.
Awesome. So I know I have several clients that, you know, have talked about this numerous times, and it's on the forefront of their mind, and they kind of giggle about it. How can we save money on taxes? So I know they would appreciate having a short conversation with you. How do they get in touch with you?
Yeah, so right on this page, probably right below this video, is an appointment link for someone on our team. Just schedule yourself an appointment. We'll go through what your situation looks like, have a strategy session. They usually run about, I usually have about 15 minutes, maybe 20 minutes of content, but usually the questions are another 30 minutes or something like that. So we'll make ourselves available. That's always free, of course. If they're coming from you, they're probably great clients. So we'll want to just provide as much value as we can on that appointment. And then if they want to engage us, that's fine. If they want to think about it for a while, that's fine too. We're totally open and available.
Awesome. Well, I so much appreciate your time today, Ron, and I'm really looking forward to seeing some of my clients see some of the benefits of the work that you do. We'll catch up with you soon.
All right. Thank you. I'm looking forward to helping them.
Thank you.
Bye-bye.